I'm Steve Hubham with Delegate CFO. Today we're going to discuss cohort analysis, or more specifically, contribution margin per cohort as it relates to the SaaS industry. We'll discuss the overall concept and give an example of this analysis in action. Stay tuned. Okay, today's topic is about cohort analysis. If you find the information helpful, please hit the like button, subscribe to our YouTube channel, follow us on social media for more information on CFO services from us here at Delegate CFO. Okay, so what is a cohort analysis? Or more specifically, what is a contribution analysis per cohort? The contribution analysis per cohort in the SaaS industry refers to the net profit a company makes on a specific segment of customers or cohorts after taking into account the variable costs related to those specific customers. Now, this metric is useful for understanding the profitability of the different customer segments and allows marketing to focus their efforts on the more profitable customers. So how do we calculate this? Well, to do the calculation of the contribution margin per cohort, first, obviously, you need to be able to identify the respective cohort. Choose a specific group of customers that you want to analyze. This can be based on factors such as acquisition date, subscription plan, or industry. 2, determine the revenue generated by that cohort. Obviously, your accounting system should be set up to be able to map the revenue to the respective cohorts. Next, calculate the variable cost for the cohort. Now, this is one of those areas that tends to get overlooked when setting up an accounting system, as identifying the revenue to the cohort is usually pretty simplistic. However, making sure the costs related to those specific cohorts sometimes gets lost in the shuffle. So this one is definitely very important. 4, obviously subtract the variable cost from the revenue. And then 5, you'll calculate the contribution margin. So you'll take that margin, divide it back into the revenue, and get the percentage. Now make sure you do that percentage calculation, because just looking at a base number of here's the net revenue you have sometimes is not as indicative as to what you want to really analyze. By analyzing that contribution margin per cohort, SaaS companies can gain valuable insights into the profitability of different customer segments and make data-made decisions on the marketing and sales strategy going forward. Now, in general, the SaaS cohorts that have the largest gross margin tend to have the largest revenue per customer, lowest churn rate, and the lowest acquisition costs. Now, these characteristics can be found in various customers and industries. However, a general example of the ones that tend to have the highest are, obviously the first is going to be your enterprise customers. These are going to be your large companies, typically have higher revenue per customer, and they're willing to pay more for premium features and services. They also tend to have lower churn rates because due to the complexity and costs associated with really switching providers. A second example, industry-specific solutions. Obviously, if you're targeting a specific industry or verticals, you can command a higher price and enjoy lower customer acquisition costs due to the specialized nature. 3, high-value niche markets. Obviously, if you're catering to, say, healthcare or finance, you can charge a premium price and have lower churn rates again on those. Long-term contracts. Again, if you have a long-term contract, you can enjoy a higher gross margin, as those contracts will provide a predictable revenue stream and lower customer acquisition costs over time. And then obviously high retention customer segments, customers that have a high likelihood to remain subscribers for extended periods of time usually will generate a higher gross margin. Again, this is because the lower cost associated with retaining those customers. Now, it's essential to note that certain large gross margin customers will vary depending on the SaaS platform and the targeted market that you're going after. Now, in essence, you need to be able to identify the most profitable cohorts for your SaaS business Conduct a thorough market research and analyze your historical customer data to determine which customer segments consistently generate the highest gross margins. When calculating the gross margin per cohort, it's important to exclude the acquisition costs. Your gross margin per cohort really is just going to be your revenue less your cost of goods sold divided by the revenue. Cost of goods sold typically includes direct costs associated with providing the service, such as hosting, development, and support services. The acquisition costs, on the other hand, are really related to just acquiring and retaining the customers, and are not really directly tied to the provision of the service itself. These expenses are really related to marketing, sales, and obviously customer success efforts. The gross margin also does not include fixed costs. Now, this is important to note because when you go through the calculation, the gross margin per cohort focuses on the costs directly associated with providing the service to that specific customer segment. This allows you to understand the profitability of each cohort and then make informed decisions about, resource allocations and maybe even pricing strategies. By excluding those fixed costs, you can better assess the performance of each cohort in relation to the direct costs incurred, again, to serve that particular customer segment. Now, let's go into just a hypothetical example. We're going to call our company XYZ. And XYZ has 3 cohorts, cohort A, B, and C. Now, cohort A is going to be enterprise fund or enterprise clients. Cohort B is going to be a mid-sized business. And cohort C will be a small business and startups. Now, let's assume for the fiscal year 2024, XYZ has the following revenue and cost of goods sold data for each of their cohorts. Cohort A has revenue of $5,000, cost of goods sold of $1,500. Cohort B, revenue of $2,500 and cost of goods sold of $750. Good. And cohort C, $1,000 in revenue and cost of goods sold of $400. Now, let's go through and do the calculation of the margin for each of these cohorts. Again, we're going to first we got to calculate the gross profit. So for cohort A, we have a gross profit of $5,000 less the $1,500, $3,500. Then we take that $3,500, divide it back into the revenue, and we get 70%. Same thing with cohort B. Revenue less cost of goods sold gives us a gross profit of $1,750, and $1,750 divided by the revenue, again, 70%. And then cohort C, gross profit calculates out to $600, and the gross margin in this one is 60%. So as you can see in this example, the gross margin per cohort for the fiscal year 2024 for these respective cohorts is 70% for A, 70% for B, and 60% for C. Now, this indicates that the enterprise clients, cohort A, and the mid-sized clients for cohort B have the same gross margin percent. In this case, it's 70%. However, cohort C is coming in at 60%. And so this data is valuable for XYZ because they can adjust their business strategy to then focus on the more profitable cohorts as they start progressing on their business strategy and for their budgets and forecasts for the future. To properly track the cohort analysis in your SaaS company, you need to make sure that your accounting records are set up correctly. First, you need to categorize the customers, beginning by categorizing your customer base on their either sign-up date or date they first made a purchase. This will help you create cohorts, which are groups of customers that share similar characteristics. Next, track the customer behavior. You need to make sure you're tracking their behavior over time, such as purchase frequency, average order value, customer lifetime value, so on and so forth. This will help you identify trends and patterns within each of the cohort. Next, segment your data. Break down your data into meaningful segments, such as product or service, demographics, marketing channels, what have you. This will then help you analyze the performance of each segment within your cohorts. Next, obviously calculate cohort metrics. Determine the key metrics for each cohort. Again, retention value, churn rate, revenue per customer. These will help you evaluate the performance of each cohort over time and identify areas for improvement. And then obviously use an analysis tool. Utilize an analysis tool such as Mixpanel, Amplitude, Google Analytics, so you can visualize and analyze your data. This will help you identify trends, patterns, insights, and so forth. And it's important to visualize the data, because sometimes when you're looking at just a table of data, just raw data, it's not as easy to be able to identify trends as it is to just a simple line graph. By following these steps, you're going to make sure that your accounting records are set up properly. However, you need to make sure that not only is your revenue mapped to the proper segment cohorts, but the expenses are also properly mapped. And I can't stress enough, periodically audit that, because sometimes the mapping gets changed or adjusted, or new accounts come in and they don't get mapped. So you need to make sure you're periodically testing it. And again, you can test it by looking at the cohorts and looking at it over time. And then obviously taking all that data and tying it up into the source records or the overall income statement. They should equal one another. If they don't, it's probably going to tell you that you have something that's not mapped correctly. So what can you do? Well, first, make sure you're actually tracking your cohorts. And obviously, make sure that the tracking actually makes sense on how you're doing that. Next, make sure your accounting data is properly mapped, especially the expenses. And if all possible, you want to avoid doing an allocation of costs or expenses. The reason being is allocations are usually based on a judgment, and a percentage incorrectly allocated could really mean the difference between focusing on a lower margin client versus a higher margin client. So the more direct costs you can map, the better. And then obviously automate the cohort analysis, and then get that automation flowing through a monthly dashboard. This should be updated monthly with your forecasts and your other KPIs. And audit and test. Please audit and test. I've seen several times where it got set up, but then again, new account came in, account got deleted, and the mapping got messed up, and the analysis was not correct. I'm Steve Hovland with Delegate CFO. Hopefully you found the answer you're looking for, and I look forward to seeing you on the next episode. Thank you.